This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello. Robert Kiyosaki, the Rich Dad Radio Show. Good news and bad news about this coronavirus economy. And we broadcast from gorgeous Old Town Scottsdale, Arizona, where it's either heaven or hell. Right now it's heaven, but there's nobody here.
And there's nobody here.
And then, so we have a very special guest today. He's a friend of the Rich Dad family. He's really been supportive of our message and our work. And is David Scranton. He's the CEO and founder of Sound Income Strategies, and he is the star of a nationally broadcast financial news program on Newsmax TV.
It's called The Income Generation.
So, David, it's nice to be interviewing you instead of you interviewing me.
Well, and thank you for calling me a star. That just sounded kind of nice for a change.
Well, we're all legends in our own mind. You know how that goes.
That's right, exactly.
And you're also the author of the book, The Income Story, Store-E. What is Store-E?
That's right. The retirement income story. Yeah, a little play on words, because the franchise that we set up, which we currently have over 24 financial advisors that are franchisees around the country that are participants in a retirement income store franchise.
I see.
So we did Store-E because little play on words. And I guess I like to make it harder on myself when I'm trying to sell books, because now people have to Google and type in funkier things. So maybe it wasn't that smart from a business perspective.
So could you give us a little bit of your background, but most importantly, why you wrote Income Story?
Yeah. Well, my background is I started like most financial advisors. I started in the 80s, and through the 80s and 90s, I was a stock market guy like virtually everyone else was back then.
Right.
The one thing, though, that I was very fortunate to have figured out was I sat there in 1998, 1999. I looked at price to earnings ratios going to infinity across the stock market, especially with the technology stocks, right? And I said, you know what? This can't be. P/E ratios of infinity don't make any sense. This is going to crash, and it's going to take a while before it gets better. So what I did is I changed my whole business model around in 1999 to specialize in income-producing investments. And that's where we've stayed really for the last 20 years. Thus the name of the show, The Income Generation.
Congratulations.
Thank you.
Tell us all about Newsmax TV and what you do with them.
Well, the show is really just to inform people that are members of the income generation, which are over the age of 50. We kind of created the term the income generation. Basically, it's the baby boomers. People who, if they haven't already, they should be making the shift from growth to income with their investments. I find that all too often people don't make the shift from growth to income until they're within a year of retirement, or they're actually retired. And in some cases, they never make that transition. So our goal is to get them to make the transition in a more timely fashion. And frankly, times like this, what's going on in the stock market just really over the last 2 months really gives us a good example of why people need to make that transition. Because right now, if you have folks that are planning to retire in the next 2-3 years, their life kind of sort of just got turned upside down, and they're probably questioning whether or not they really can.
Right. Again, David Scranton, he's interviewed me on Newsmax TV, and he supports what we do at Rich Dad here. And it was the last time I was on your program was about who stole my pension. And that's right.
And
what I've been saying is that once this corona stuff kind of dies down, the next big headline is who stole our pensions. And do you share the same concern?
Yeah. I do have the same concern. And frankly, I had the concern a little bit. And then after reading your book, I had the concern even more. Thank you very much for giving me one more reason to stay awake at night. But it's all the more reason I believe that when people invest with their own dollars, whether it's in a 401k or whether it's elsewhere, making that transition from growth to income, as I call it, from the G to the I, needs to be done in a timely fashion. Because you may think, gosh, all this money I have over here is gravy. I don't really need it. I have a pension. I have Social Security. I'm looking good. But, the Social Security Administration right now is underfunded. And if they don't make any changes within about 15 years, benefits are going to have to be reduced by 20 to 25%. And with fear about pensions, at this point, I think Americans have to realize that they really can't count on anybody but themselves. At the end of the day, they've got to take matters in their own hands when it comes to their own financial security, especially during retirement.
Right. So I'm glad to have you on the program, because I want to know from your position, what's happened after this post-corona crash and all that stuff. What do you see happening to
And especially
pensions?
when it comes to pensions and retirements, and especially baby boomer retirements, what's happening?
Well, what's happened so far is Wall Street has given us an enormous gift because, when you look at unemployment, I compare it to, this is what I call a black swan event. It's an event that couldn't be predicted. It's a tipping point in the markets that has humanitarian factors, all kinds of social elements, as well as economic factors. And when these kinds of things happen, they're really hard to predict what's going to happen. So I find the best thing we can do is compare it to what happened during the Great Recession around 2008, i.e. the financial crisis, and also to compare it to what happened during the Great Depression. So if you look at those two things, let's look at unemployment first. Okay, unemployment during the Great Recession got to about 10% at the trough. That was 2008. During the Great Depression, unemployment got to 25%. Right now, unemployment is about 20%. And every Thursday when a new report comes out, it gets higher and higher. A lot of people are expecting it to match or exceed the 25% peak unemployment rate we saw during the Depression.
David, let me just ask, when you're saying 20%, is that 20% because of the coronavirus, before the coronavirus, after?
Total, we were at 3.5% unemployment. We've added another 17% or so with those 30 million jobs that have been lost over the last 6 or 7 weeks. And of course, every Thursday, that number goes up. So right now, our total unemployment is somewhere over 20%. We don't get an actual number published yet. But by looking at the 30 million lost jobs, you can pretty much interpolate that it's slightly over 20%.
So my question is, how does it affect 401k? Or, Mitch McConnell just whispered the word bankruptcy. He's a senator, majority leader from Kentucky. And bankruptcy sent ripples through the whole thing because that means the defined benefit pension, which is firefighters, school teachers, and police officers, they estimate that until March 2020, it dropped from 16% funded to 9%. That means if the pension needs $100, they only had 16, and now after March 2020, it's now $9. So when McConnell whispered the words bankruptcy, that sent shockwaves through the whole system because that might mean, and I'm an expert in this, that the state may say to the teachers, firefighters, and police officers, aloha, you might not get anything. Is that your understanding?
That's right. So let me give you a short-term and a long-term answer, then let me give you the wild card, okay? Because when I compare the GDP loss, the economic output loss that's being projected for the second quarter, again, it's the same thing. It compares more to the Great Depression than it does to the financial crisis in 2008. And during the Great Depression, the stock market dropped 90%. During the Great Recession in 2008, it dropped 56%. Right now, we're only down less than 20%. So what does that mean? Long term, I believe that we need to have another significant leg down in the stock market. And that's going to affect pensions a little bit because pensions don't have a ton of money in common stocks. They're more bond-based, as you're well aware. But it's really going to affect people's 401ks if they stay in stock mutual funds too long. Short term, though, it gives them an incredible opportunity. We've been given a gift by Wall Street. The talking heads on TV call it a dead cat bounce. That's when the market drops like it did in March by 40%, and then it just bounces back up more than halfway. It's a great opportunity for those people who are retired or within 10 years of retirement to start to take some money off the table, to start to get it out of the stock market into more conservative things to protect what they have. And this happens there in every down market. There's always these upswings, these opportunities, and those people who are active, who aren't sitting on their hands, take advantage of them and protect themselves. So long term, I think it's very bad what's happening because I do think we have to have another significant leg down in the stock market. Short term, though, we've been given this great opportunity. The wild card in all this is the Federal Reserve. There's a saying out there that says, don't fight the Fed. If the Fed's going to print money and just sprinkle it all over the entire economy, well, then the stock market should do fine. And generally, I agree with that. But the only problem is that at the end of the day, it's only going to really help long term if this money that's getting sprinkled throughout the economy is actually spent. And right now, most people I talk to just don't feel comfortable. If you have an unemployment rate of over 20%, let's face it, how can people feel comfortable spending the money? So I think this recession is going to be deeper than anything we've seen in our lifetime. I feel pretty confident of that. Now, when that recession goes deep, not only does it affect the stock market, but it also affects bond defaults. So now if it affects bond defaults, that's where it's going to most have the ability to affect the pensions that you're talking about, because those are laden with bonds that, and even a lot of investment grade bonds could see some defaults. So I know, for example, in our portfolios, we're being really, really careful to look at cash burn rates. We're looking to see, okay, if this company gets no revenue for over a year, can the company still pay its basic bills? Just like, if you got laid off, right? The first thing you would do if you lost your job is to say, okay, and I know you haven't worked for anyone for a long, long, long time, so it's probably a bad example, but if you did, and you got laid off, the first thing you do is say, okay, how long can I pay my bills out of savings? Yep. So that's exactly what we've done, and hopefully these pension funds are doing that too with their own bond analysis.
I was just going to say, interesting to your point about people not spending the money. So I just was reading stories of, these small businesses, PPP loans, small businesses getting these loans. They have to spend it, and they're not spending it, and they have to spend it in this time period, or they are basically it's a loan, and they're not spending it, a lot of them.
Yeah, and if they do spend it, they might spend it to keep people employed till September 30th. But again, if we haven't really gotten through this whole thing by then economically or certainly medically, then they're going to end up laying people off September 30th. So I think this PPP thing to a large degree is just kick the can down the road unless they're willing to come up with round after round. And then you have the whole question of what this mushrooming government debt levels will do to the economy long term. And when you start to get to that, I almost think that you start to get beyond my personal pay grade. The top economists in the world could sit and talk about that and the long-term effects of it. But the reality, though, is that we've never seen this. It's the first time in the history of the world that we've seen debt bubbles popping up with governmental entities all across the globe.
It's global. And this is my question to you, David, since you deal with a lot of people on a pretty personal basis, their portfolios and all this. So let's say that person comes out of the equities market, the stock market, and has $1 million in cash. Where would they put it? Mm-hmm.
There's two camps. One is the one that is maybe a little younger or has a little extra money than they really need, and they want to be opportunistic. Cash is king. The rich get richer for a reason. When real estate goes down, they have cash reserves, they buy real estate. When the stock market goes down, they have cash reserves, they buy stocks. As average investors, we're taught to buy and hold. We're taught to stay fully invested because we're told that by advisors that, it's not about timing the market, it's about time in the market. Or, over the long run, the market always does better. So these tired old cliches are forcing a lot of average investors to stay invested no matter what. But that person wants to be more opportunistic, who wants to be a capitalist next time the market drops versus being a victim of the market drop, has a great opportunity right now to keep some money in cash and just wait and be patient, because there'll be a lot of good buying opportunities coming up if they've got the psychological makeup to take advantage of it. Now, what if you don't have that makeup? What if you're not that kind of person? What if you're a boring investor like I am, like loving bonds and bond-like instruments, investing for the I instead of the G, income instead of growth? Well, then if you're more concerned about protection, then you could still get into that world of bonds and bond-like instruments and get a 4, 5, or even 6% consistent interest payment, consistent dividend payment. Not a dividend that's likely to get cut like half the common stocks that are out there today. Some of the biggest companies in the world have cut dividends or eliminated dividends over the last 8 weeks. So not like that, but in things that contractually have a fixed dividend rate or a fixed interest payment.
Okay.
So you kind of have a solution whether you want to be opportunistic and capitalistic or whether you just want to be protective.
So the reason we'll be coming back to take a break, but our guest today is David Scranton, because a great friend of the Rich Dad Company, always supports our works. And we're discussing what does a person do in the post-corona economy. So I want to come back because my big concern is when people say, what should I do with my money? I agree with what David just says. We're standing on the sideline right now. We're just watching it. Mm. But as some of you follow the market, the equity market, the stock market, all-time highs, the bond market's all-time highs. And that's kind of a spooky time. So when we come back, we'll be discussing what David Scranton sees, what we can do in the post-corona economy. We'll be right back. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. You can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android and YouTube. And please leave a comment or a review whenever you listen. And all of our programs are archived at richdadradio.com. We archive them for one reason. We're a financial education company, and we strongly recommend repetition is the way you learn best. So if you listen to this program one more time, you'll have whole new insights about what's going to be happening in the post-corona crisis. So our guest today is David Scranton. He's the founder of Sound Income Strategies. He's the author of a great book, The Income Store E, capital E, was released in 2019. And he's, like I said, he's broadcasting on Newsmax TV.
And he's the host of The Income Generation. And what else I love about David is because David is a friend of the Rich Dad Company and understands our philosophy and practices a lot of that philosophy. And you're training financial planners. So that gives us some very optimistic outlook on the future of financial planners. If you're teaching them this whole about growth, income, and cash flow, and we're happy about that. Happy to hear that.
It is all about cash flow. And you teach that so well. And the reality of it is, you know, even with people, like I said, retired or close to retirement, it's all about cash flow. These people who try to engineer income by staying in mutual funds too long and taking systematic withdrawals from mutual funds throughout retirement. I don't think most of them realize the risk that they're actually taking.
Right, right.
So without giving away your trade secrets, what are you recommending for the old guys who have to retire pretty quickly?
Well, there's no one blanket recommendation, of course, but if you have to retire quickly, you have to sit down and say, okay, am I able to retire on the lifestyle that I want, or do I have to reduce my lifestyle, change my lifestyle right now? And for many, they have to alter it. So we sit down with them, first of all, and say, okay, do you want to draw income from your investments now? Do you want to work part-time, maybe draw a little less to let it build up? How is this going to look in an ideal world? Because that affects, too, how we make investments. As a general rule, we're focusing more, though, on income-based strategies. Because if someone lost their job and they're working part-time or they're working another position at a lower income, they may be able to live off their income, which is great. If they can live off even a part-time income and let their money grow, that's wonderful. They may not be able to add to their accounts, but if they can let it grow, it's wonderful. But most of them cannot do that. So they still have to get some income from these accounts, which makes it tougher because then it means that you can't let them grow organically, which means now that's all the longer that you may have to work part-time or in some alternate position. So again, it's a custom-made thing, but the real issue is that, for a lot of those folks, they really hope that they can go back and find employment that is complementary to their skill set. And it's hard because you start getting your later 50s, especially in your 60s, it's harder to find work because, a lot of employers today, you can't legally age discriminate, but you kind of know that all employers to some degree do. And it unfortunately, it can't be, I shouldn't say all, I should say most, but unfortunately, it can't be proven. So it's one of those things that older folks who got forced out of the workforce really just have to deal with.
Okay, so when I was a kid, nobody was in the equities market or stock market. Everybody when I was a kid was in the bond market. But as most of what I write about is after 71, Nixon took the dollar off the gold standard and all this fake money started flooding the system via debt and credit. So it blew all the markets, real estate, bonds, equities, into this massive bubble. So 2000, it crashed with the dot-com crash, 2008, the subprime crash, and now March 2020, the corona crash. So what's going to happen to bonds if, it's been a bull market for so long? How does a person make money in bonds?
Well, first of all, let's remember a couple of things. Bonds are always more conservative than stocks because, with the stock market, you have to worry about the fickle whims of Wall Street, and a company could have a good prognosis, but if Wall Street for some reason is nervous, the stock price goes down. Bonds, the biggest issue is worrying about default. So the nice thing about being a bondholder is you never worry about whether the company's in favor with Wall Street or out of favor with Wall Street. All you care about is really one thing: can that company pay back their debt? The good news is at today's lower interest rates, companies can carry a lot more debt. So people talk about the debt ratios in corporate America having gone up so much. And whereas that's true, I think it's more important to talk about debt service, how much the interest service is on the debt relative to their corporate profits. And that hasn't changed all that much. It's created more of a bubble because of a lower interest rate environment. So, ultimately, we don't know how this thing's going to play out. And I agree with you. All these fiat currencies being taken off the gold standard, I think, are really problematic. but it's happening with every country. We're kind of all in this together. In fact, I believe that's the reason why, the cryptocurrencies like Bitcoin, became so popular, because people are thinking, well, we got to base this on something. Whether Bitcoin will ever take off or not, I don't know. I'm personally skeptical. But the only thing I would say is if there is a massive explosion due to the fiat currency, at that point, it probably doesn't matter whether you have money in the stock market, in the bond market, or in banks. Everybody's in trouble. So I've got to hope that all gets worked out in some way, shape, or form. And at the end of the day, people can't retire off the interest that's in bank, getting paid by bank accounts anymore, or the government bonds, by the way. And retiring off the stock market is risky business, especially with dividends getting cut left and right or eliminated. So the bond market is still the best way to go. But it's harder now because the analysis that you have to do with bonds is more in-depth than ever before. So I always tell people, don't try this at home. A lot of do-it-yourself investors used to go to Moody's, Standard & Poor's, look at the ratings. Oh, it's investment grade, I'm going to buy it. Well, I think you can't do that anymore. You have to look a lot deeper than that and look at a lot of the ratios and do your own analysis. And again, that's why I always make the comment, don't try this at home.
So, wait. You said also you can get a 4 or 5% return. That sounds high. How would you get that?
Today, you can get that in the bond market. You can get that a little more than that in preferreds. And preferreds are, as you know, preferreds are basically a bond-like tool. They're technically a class of stock, but they have a par value like a bond. They have a fixed dividend payment like a bond has a fixed interest payment. So they're very secure instruments. So when you start to look at a blend of some of those things, you can be getting 5.5% average returns.
Wow.
But it's not like in the stock market. The stock market for the first 20 years of the century, the S&P 500 averaged 5.8%. But you went through a heck of a roller coaster ride to get that 5.8% average return. Here we're talking 5.5, just steady Eddie through the bird in the hand, the interest and dividends.
Well, definitely people should contact you because I sure don't know where that is. But anyway.
Hey, so David, there's with all the stimulus that's happening right now with the coronavirus and small businesses and individuals and companies, and they're printing a lot of money, and now they're going to print more money. What's your forecast in how this plays out? Because it doesn't seem like they have any other solution except we're just going to keep printing money and keep giving companies and giving individuals money.
You mean how it's going to play out ultimately economically for the country, for the world, as this deck just mushrooms? Or do you mean how this particular thing is going to play out economically and with the stock market for your listeners?
For economically, globally.
Well, that's the comment I made before, that question is way above my pay grade. And I believe it's above the pay grade of the smartest economists in the world. Because at the end of the day, they don't have a model to follow. This has never happened before with world governments in a pandemic way. And I don't mean pandemic in a medical way. I mean it in a financially pandemic way. So we don't have a playbook. And I'll give an example of something I thought was much more predictable. In fact, I did predict it, in 2007, but most economists never predicted this. When we started printing money with all the quantitative easing during and after the financial crisis, all the economists said, well, we're going to have hyperinflation because the textbook says, these are smart economists, the economics textbook says if you print money, well, you're going to get inflation. And right in 2007, I said, and in fact, I said it in a newsletter to my clients, I said, wait a minute. I think it was 2008, actually. I said, wait a minute. That's under the assumption of all these old textbooks that when the government prints money and floods the economy, that people use that money to buy goods and services to stimulate the economy. But nobody's bothering to ask the question, what happens if people don't use that money to buy goods and services? And it doesn't stimulate the economy. Well, the reality is you get deflationary pressures instead of inflationary pressures. And that's why the Federal Reserve, basically standing on its head and spitting nickels, so to speak, for the last 13 years, has tried to manufacture inflation, and they've had a really difficult time doing so because that deflationary pressure. So economists, I think, across the globe got that wrong because they're blindly following the textbook. This issue that you mentioned that is ahead of us now is harder than ever before, and I believe it's even above my pay grade in answering that because it's one big lab experiment. And when you do a lab experiment, you start to pour chemicals together that have been never mixed, you really don't know what you're going to get until it actually happens. We can get a very nice benign outcome, or we can end up with an explosion. And all we can hope for, again, is that since the world is in this together, I used to say the Western world, but now China's got a lot of debt also. So it's not just the Western world anymore. When we're all in this together, all I've got to think of is that if all the economies kind of blow up at the same time, then effectively nobody blows up because we're all in the same boat. And I don't know whether that's wishful thinking or what I actually think, but I have to tell you very honestly, that's all I got on that particular topic.
I was afraid of that.
Yep.
On another subject, because you work with a lot of baby boomers, I'm just curious. What is the, let's say, pre-coronavirus, what was the situation with baby boomers and retirement? Were they in a good position? What percentage were in a good position? Are they preparing for retirement, or are they just hopefully wishing?
Well, you get both camps. Before the coronavirus crisis, most studies show that only about 20% of baby boomers were in a good position. The other 80% were really behind the 8 ball. And if you take that 80%, there were some that were really focusing on it, but just got a late start. And some that were just kind of throwing caution to the wind and hoping for the best. And because they have what the and Robert, you know this, right? They have what the FAA calls resignation, right? You know, all the pilots' hazardous attitudes. Well, resignation, the FAA calls it, is when you have an engine failure in an aircraft, and you just kind of throw up your hand and say, well, it's in God's hands. There's nothing I can do. There's nothing I can do. And you don't take action to control the aircraft. Whereas you probably know, Bob Hoover says, fly the aircraft as far into the crash as you possibly can. Any pilots that are listening to your radio show know what we're talking about there. But same thing here. You know, a lot of people have this resignation. They just give up and say, there's nothing I can do. It's too late. So I'm going to do nothing and hope for the best. And you know, I have a friend of mine, a close friend, that did that. And it's kind of a sad situation. It's very sad, but in another way, it's not. He kind of threw up his hands, and his whole goal was he bought a huge life insurance policy and said, well, if I die, I want to make sure my wife's taken care of, but otherwise I'm going to work the rest of my life. I have no plan. And unfortunately, he died at the young age of 59. And so for him, not saving was a good thing because he never would have gotten to enjoy it. And he was smart enough to at least take care of his wife. But it was still sad because, you know, part of me wonders sometimes if some of the things that led up to his death are partially because in his mind, he knows he didn't have a plan B. He knew that he's either working forever and never going to be able to retire or he just dies early. So it's really across the board.
So David, you know, running out of time, love to talk to you more. Big question is, how does somebody contact you if they want to engage your services?
You go to TheRetirementIncomeStore.com, or you can go to SoundIncomeStrategies.com. Sound Income Strategies is our money management arm behind the Retirement Income Store. And just Google those, look them up, and our phone number's there. You could send me a note or give me a ring on the telephone. I happen to be more of a telephone person than an email person. So I'd love to talk to anyone who wants to talk about their own financial security going into retirement.
That's a good point.
I do have one other question, because you mentioned this earlier, and I think it's a really important point. You talk about a person's psychological makeup. So how does that play into the coronavirus and the fears and all of this? Because psychological makeup can make or break a person.
Yeah. I mean, first of all, I think it's part of what I just interviewed earlier today, actually, Ben Carson. And, you know, we're talking about the whole psychology about, you know, what's going on now with the virus and how it's affecting people, and the difficult decision the president has to make right now, trying to decide, okay, you know, more people will die if we open the economy, but then also how many people will die if we don't open it? How many more cases of depression are you going to have, or even suicide or thefts that end up in a shooting, those kinds of things. But in terms of investments, I think it's really caused people to really get more depressed about their prospects of retirement, because now they're worried about their job security. The markets are down. They're concerned about, okay, I was behind the 8 ball, now I'm even more behind the 8 ball. And I'm just hoping and praying that people don't just throw up their hands and say, you know, there's nothing I can do. This is the time to take action. This is the time for all of your listeners to take action, to do something, whether you want to be opportunistic or you want to be protective. Nobody says you have to ride the market all the way down just to ride it back up again. So that's the biggest message I want to get across now is don't do nothing. I really strongly believe now is a time not to sit on your hands.
Excellent.
Thank you. Thanks for serving your
David.
communities.
Well, you too. Thank you for the service that you folks do.
Oh, it's very important stuff. So, David, thank you very much.
Thank you, David. Really appreciate it. Great information.
And make sure
You're
people
very welcome.
contact you.
Thanks for having me on.
Okay.
All right.
And we'll come back with the final words from Kim and I. We'll be right back. And thank you, David. Bye. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And again, I want to thank David Scranton. You know, he's the CEO and founder of Sound Income Strategies and his latest book, The Income Store, capital E, Store E. Very important man, especially if you're planning a retirement like most people eventually, hopefully will do someday. And his talk today was what's going to happen in the post-corona economy. And I personally believe the world has been changed forever, so the old formulas stop working. Any comments?
Yeah, I think one of the most important things that David said was, in this time right now, don't throw your hands up and do nothing. This is the time to do something. Yeah. And what I like is that, you know, he teaches individuals, but he also trains a lot of financial planners, and he teaches them in the cash flow strategies on how you find assets that produce cash flow. And yeah, this is definitely has changed the game, but there's still a lot you can do, and especially if you're sitting at home now and you're not working. This is the time to get smart, to get educated, to start looking at what you can do instead of saying, "Oh my God, I'm a victim, I can't do anything," because there's a lot you can do.
And so one more thing is that Rich Dad makes no recommendations on any investments. We'll tell you what we invest in, but we don't recommend any investments. So that's what David's job is. And again, like anything else, you got to make up your own mind. Before we end, is that, you know, Kim and I, we wrote a book called Retire Young, Retire Rich. And we did it in about 10 years. You know,
Yeah,
since
it took us
met.
about 10 years.
And the situation is similar. We did it through real estate because the markets had crashed. And we like crashes. The only question I'm hesitant about recommending that strategy is we don't know when it's coming back. And this one might be a long depression. So exactly as David is saying, and we say, it's really time to start studying and, you know, figuring out what you can do. Like we had George Gammon on. Watch his stuff, you know, on YouTube, so you can figure out what's going to happen in the future, because this is a very strange time right now.
Yeah. And, you know, I was just talking to Ken McElroy, our Rich Dad advisor on real estate and our real estate investment partner. And he's saying there are things that will do well real estate wise in the future, and there's going to be things that are going to disappear, like a lot of retail in the malls. 50% he's predicting is gone. So, but there are opportunities out there. But again, you got to study, you got to learn from people like George and like David Scranton, and you got to figure it out.
So in actuality, there's more opportunity today because of the crash. But how do you know a good one from a bad one, and are you capable of handling it? And I'm going to promote my latest book. It's with Ted Siddell. He's an SEC attorney, and it's called Who Stole My Pension? It's a very important book to read because it talks about how Wall Street is robbing our pensions. It's amazing we haven't been shot yet. But anyway, if you want to find out how Wall Street works, and including the 401k and all these defined benefit plans, Wall Street is kind of the culprit, plus the guys that manage your retirement plans. So a lot of times you're dealing with people you think you can trust, and you find out they're the worst people on planet Earth. But I leave that decision up to you. The reason Kim and I have no money in the stock market is we simply don't trust them. Any comments on that?
Oh, we have absolutely no control over the stock market. Yeah. We have control over our real estate. We have control over our businesses, but we have no control in the stock market.
And it's not that we don't ever lose and stuff that make mistakes. We do, but that's how you learn. So Kim and I are doing extremely well right now, better than ever before. But we paid the price. It's called we invest in our financial education. We listen to people like David Scranton and George Gammon and all the guys, Jim Rogers. There's so much going on right now. There's also more opportunity. So again, Retire Young, Retire Rich. If you want to get out young, retire that. Read that book. It's done with real estate. And then Who Stole My Pension? If you have somebody who's counting on their pension, get that book for Christmas for them. Thank you for listening to the Rich Dad Radio Show.
Thank you very much. We'll see you next time.
đường làng quanh co sông thu êm đềm thả diều đá bóng nắng cháy giữa đồng kỷ niệm yêu thương trong mỗi ngày ấy tiếng ru gọi hãy nhớ biết bao tôi xa quê bao năm tháng qua nhưng trong trái tim không bao giờ xa lời mẹ ru con hiu hiu chưa hè mùa lụt nước lũ bắt